The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everybody. Welcome to today's live Interactive Brokers webinar event, which is brought to you in conjunction with my friends over at ProShares. And today's topic will be capitalizing on tactical market opportunities using leveraged and inverse ETFs. And I'm delighted to introduce to you Troy Goldstein, who's the Executive Director of National Accounts, and to Lex Gerlach, who is the Tactical Investment Strategist over at ProShares. And before we go to our friends over at ProShares, I'm going to ask the presenter to put up the IBKR disclosures. If you can just pay attention to the some of the risks associated with some of the material in today's topic, that would be appreciated. Before we move on to the opening slide. So just a couple of pieces of housekeeping, folks. Today's event's being recorded, and if you watch your inbox in a couple of hours' time, you'll see an email from Webinars at Interactive Brokers, and you'll get the opportunity to click the link and visit the recording if you don't get to watch all of today's event. There is a handouts button in the GoToWebinar pane there, and you can download today's PDF courtesy of ProShares. And if you have questions, we're not going to have a live Q&A due to the nature of today's content, but we will get those questions over to Troy and Lex, and they will come back to you by email. So please do add your questions to the question panel. So without further ado, I'm going to introduce Troy Goldstein and Lex Gerlach, and I'm going to go on mute. Guys, over to you.
Welcome, and thank you for taking the time to be with us today. We plan on providing insight on how you may potentially capitalize on tactical market opportunities using leveraged and inverse ETFs. So, who are we? I'm Troy Goldstein, Executive Director, Head of National Accounts here at ProShares, and I'm going to serve as your host today. Prior to ProShares, I spent the majority of my career at UBS holding key distribution roles here in the United States, Switzerland, and London. Joining me today, as mentioned, is Lex Gerlach. Lex Gerlach is Tactical Investment Strategist, and Lex joined ProShares in 2015 as an investment strategist focused on portfolio analysis, education, product research and development, and the presentation of investment strategies using the company's tactical ETFs. Prior to joining ProShares, Lex held positions at JP Morgan Private Bank and Vanguard. He earned a bachelor's degree in economics from Haverford College and is a CFA charter member. So with that, let's go to our agenda. We look at our agenda today. We're going to discuss number one, tactical opportunities in the current market environment. We're going to review leverage and inverse investing strategies, and of course the considerations in doing so. We will then walk through the mechanics and fundamental concepts of leverage and inverse ETFs. Lex will touch on some hedging case studies in which both on the equity side, hedging equity, as well as fixed income exposure. Lastly, I will wrap up with some closing comments and let you know how you can contact us or one of our tactical consultants for more information. So let's go ahead and get started and look at the market environment this year from a couple different angles. And in starting with this slide here, let me take a minute to review activity in broad market equities. As you know, we've seen some notable changes in market leadership. When we look at year-to-date performance, and this is through April 16th, by the way, it's important to keep in mind how certain segments of the market performed last year. For example, while the S&P 500 and Russell 2000 returned between 18 to 20% in 2020, the NASDAQ 100 gained nearly 50%. So far this year, we've seen the NASDAQ 100 lag over other broad market U.S. indices, while mid and small caps have had a strong rally and really have rallied on the back of supportive stimulus and optimism for the economic recovery. Additionally, when we look across market caps in the U.S., there's been a noticeable contrast between value and growth performance. If you look at year-to-date, S&P 500 value has actually returned 14.3% compared to 9.8% for its growth counterpart. Again, 14.3% compared to 9.8 for its growth counterpart. The mid-cap 400 value has actually returned 23.1% versus only 13.7 for its growth counterpart. And the Russell 2000 value has returned 23.6% versus only 6.8% on the growth side of the equation. So as the year and the reopening of the economy progresses, active traders will likely be looking for opportunities to continue to capitalize on the strength or the weakness in certain market segments, given the amount of performance dispersion that we've experienced thus far already. So, continuing with some of the points that I mentioned on the previous slide, we've seen wide performance dispersion within sectors as well this year. Some of the worst performing sectors last year, energy and financials, for example, are cyclical sectors taking a strong turn higher this year and have become some of the top performing sectors. Energy in particular has really benefited from the surge in oil prices and expectations of a strong economic recovery. If I think about it, the difference in performance between the best performing sector this year, energy, and the worst performing sector this year, consumer staples, it's been 25%. It's a big dispersion. The largest S&P 500 sector by weight, technology, has been the top of or towards the top of the sector leaderboard in recent years, but it's taken a breather so far this year after a really strong run. You know, while there continues to be strength and growth in the tech sector, it has faced some headwinds this year, including the impact of rising interest rates and really the reassessment of valuations, right? Overall, this year really may provide a number of opportunities to capitalize on short-term moves in the market, short-term moves in sectors, and really managing risk within those sectors, or to simply reevaluate overall sector exposure within a portfolio. One last area of the market I want to cover, and that's really experienced a lot of movement and attention, is Treasury yields. While the Fed funds rate is anchored near 0%, and short-term Treasury yields have been pretty stable and hovering just above zero, intermediate long-term Treasury yields have been on an upward trajectory and reflect optimism for increased growth and inflation. Both the 10-year and the 30-year Treasury yields have increased more than 60 basis points this year. 60 basis points. The Federal Reserve and Jerome Powell have a challenging job of managing their policy measures and communicating their thoughts in guidance to the public. You know, investors have been keenly focused on the wording that Powell's using during Fed meetings, and the markets can really be quick to react accordingly. You know, should we see continued growth, continued strength in growth and inflation through the rest of the year, there may be increased movement in treasuries and an even more watchful eye on shifts in policy or even just the tone of the Fed. You know, while many investors often think about hedging risk on the equity side of the portfolio, given the fixed income environment, it may be prudent to actually think about hedging fixed income exposure too, which we'll talk about a little bit later on. So, as I started to hit on, and you're likely already aware of, you know, for managing your own investments, we continue to live in a unique market environment. There are a number of opportunities to tactically capitalize on moves in various segments of the market. At this point, I think I've set the stage, and now I'd like to bring in Lex. And Lex, could I ask you to kind of walk us through some of the different leverage and inverse investing strategies that are available to investors, and some of the different considerations each of these options bring with them? Lex?
Sure, thanks, Troy. When we think about leverage and inverse investing just at a high level, these concepts are not new. Investors have been using varying ways to get leverage and inverse exposure for a very long time. Margin, short selling, options, and futures were traditionally used to gain this type of exposure before other vehicles became available. The first leverage and inverse mutual funds were introduced in the US in 1993, so they've been in existence for nearly 30 years now. The largest providers of these types of funds are ProFunds, Ridex, and Direction. Then in 2006, the first batch of leverage and inverse ETFs was brought to market in the US by ProShares. And the range of leverage and inverse ETFs has really expanded considerably over the past 15 years. Traditional leverage and inverse strategies using margin, options, or futures, for example, have typically been either out of reach or they just might be simply too risky for many investors. They typically require margin accounts, special brokerage approval, and significant collateral requirements. They can include premium fees, borrowing costs, and other fees, and they tend to have higher risk. With traditional short selling, for example, losses are not limited to the amount invested. Whatever the price of the investment rises to, the investor will have to pay it in order to return the shares when they're required. And it's also worth noting that with traditional leverage, investors are subject to margin calls if the security drops below a certain amount. Now, let's switch gears and consider leverage and inverse ETFs and some of the advantages of using these vehicles. These funds offer a number of advantages to investors since ETFs don't require margin accounts, typically have no minimums. Investors can buy one share if they desire. They may have lower costs than traditional inverse and leverage strategies, although you do want to be mindful that ordinary brokerage fees would likely apply. They enable investors to enter and exit positions at any time throughout the day if people desire. So there's that flexibility component as well. And of course, these ETFs do carry their own costs and risks, such as trading costs and tax consequences, but they really can be valuable tools for many investors. As I mentioned earlier, leverage and inverse ETFs have been in existence for about 15 years now. And the range of ETFs available has expanded greatly and gives investors a broad menu of tools to select from. We offer about 100 leverage and inverse ETFs at the moment, spanning asset classes, so equities, broad markets, sectors, thematics, international, and also fixed income, currency, commodities, and volatilities. And they span daily multiples ranging from -3 times on the short side to 3 times on the long side. Now, most recently, with the incredible growth in the thematic space broadly, we actually expanded our lineup by launching leveraged thematic ETFs, 2 times daily leverage funds tied to cloud computing and cybersecurity benchmarks.
Interesting, Lex, and I think that between the two of us, we've really kind of provided a basis for our discussion today and the overview of leverage and inverse strategies, and additionally some of the ProShares lineup. I want to ask you now to kind of dive a bit deeper and focus on the mechanics and fundamental concepts of inverse and leverage ETFs, if I could.
Sure, and let me just start off by introducing how leverage and inverse funds work. Their performance objective is designed to deliver a targeted multiple of a reference benchmark for a single day before fees and expenses. So for example, as the benchmark in a leverage or inverse fund goes up 1%, a conventional index fund would increase 1% with it, while a 2 times leverage fund would increase 2%. And the same type of return happens on the inverse side as well. So with a 2 times inverse fund, when the benchmark goes up 1%, the fund goes down 2%. And when the benchmark goes down 1%, the inverse fund goes up 2%. And just as a quick reminder, as I mentioned earlier, these examples do not factor in fees or expenses. Now, while we discussed that ETFs do make leverage and inverse strategies more accessible, we really believe investors need to understand them well before using them. These types of ETFs are tools with a whole range of applications. Leverage long funds can be used in a number of ways, and I'll give you a few examples. They can be used to profit from rising markets through directional trades. If you have strong conviction that the S&P 500, for example, will rise over a certain time frame, a leveraged ETF can be a valuable tool to express your view. These ETFs can also be used to overweight a segment of the market. So let's say a portfolio manager runs a sector rotation strategy and wants to overweight the tech sector. Leveraged ETFs can be used in a situation like this to overweight a desired segment of the market. Now, one of the appeals of leveraged ETFs is that they can be used to increase exposure to an area of the market for less cash. This is essentially capital efficiency when you think about it. An investor might desire a certain amount of exposure to the market, but you might not always have the luxury of having enough cash on hand for the investment. So using leverage is a way to magnify your exposure for less cash. It can essentially be thought of as an efficient deployment of capital. Now, let's switch gears and look at some uses for inverse funds. Inverse funds can be used by investors seeking to profit from declining markets through directional trades or to underweight segments of the market. Additionally, inverse ETFs can be a valuable tool in a hedging strategy to offset potential declines in long investments. And we'll look at some hedging examples later on in this presentation. These are really some of the common applications for leveraged and inverse funds. There are, of course, others, but these are really some of the core applications. Investors should have a comprehensive understanding of the features, benefits, and also risks associated with these funds before using them. And additionally, investors should be prepared to monitor their positions frequently, even as often as daily. I'd like to take a minute now to review the one-day investment objective of leveraged and inverse ETFs. And this is one of the core points to understand. Typically, leveraged and inverse ETFs are designed to meet their investment objective or their multiple for a single day only. Now, to maintain their daily investment objectives, leveraged and inverse funds rebalance their exposure to their underlying benchmarks each day by trimming or adding to their positions. Without this one-day objective and daily rebalancing, the fund's exposure to its benchmark would float over time. So for example, a hypothetical 2x leverage fund that didn't rebalance and have a daily investment objective could see its exposure drift from 2x over time. It could drift to 1.5x or 2.3x or some other exposure amount depending on the change in the market. So it's really important that leverage and inverse funds have a daily objective that can deliver that targeted daily multiple on an index on any given day. This graphic below, it illustrates how the daily rebalancing works for a hypothetical 2x leverage fund. Let's assume that this fund has $100 in assets. As a 2x fund, it would have $200 of exposure. If the market rises, let's say 10% for the day, the fund would gain 20% and have $120 in assets. The exposure would rise 10% to $220. For the fund to be able to deliver 2x exposure and returns for the next day, it needs to adjust its exposure. With $120 in assets in the fund, it now needs $240 of exposure to provide 2x exposure. So an additional $20 of exposure is needed through that daily rebalance. As a result of the daily rebalancing and compounding of each day's gains or losses over time, the returns for periods longer than a day may not, and they're just not designed to, equal the fund's stated multiple times the benchmark's cumulative return for the period. So to put it in plain English, if you're holding a 2x S&P 500 fund, for example, and the S&P 500 is up 10% over the course of a week or a month or some other period longer than a day, the fund should not be expected to simply deliver 2 times 10% or 20% for that period. The market environment and volatility during your holding period can impact performance for periods longer than a day. And this is what we're going to take a look at on the next slide. Here, I want to spend some time reviewing the one-day investment objective. Sorry, now that I've reviewed that one-day objective, let's transition a little more to portfolio realignment, and let's take a look at that compounding and performance over time in leverage and inverse funds. Typically, compounding is magnified in these types of funds, and especially in those with larger multiples or exposure to volatile benchmarks. While compounding can enhance returns during trending periods, it can hurt returns in volatile ones. So let's start at the top here at the table, and let's walk through some examples. At the top, in the upward trending period, and this is shown for the hypothetical 2x leverage fund, as the benchmark goes up 5% each day, it doesn't return 10% over 2 days. Its compounded 2-day return is 10.25%. And if you look at the 2x fund returns on the right column, it delivers 2 times the return of the benchmark each day, so 10% each day. The return over 2 days isn't 20%, the compounded return is 21% over the same period. So you can see that the 21% return is greater than 20.5%, or 2 times the 10.25% benchmark return. So this is an example of compounding in a leverage fund enhancing returns. Now, in the downward trending period, and this is shown in the middle portion here, while the benchmark loses 5% each day for a total of negative 9.75% over the 2 days, the 2x fund loses 19%. So that's better than negative 19.5%, which is 2 times the negative 9.75% return of the underlying index. So in the downward trending period, compounding in the leverage fund, again, enhanced returns. Now, lastly, in the volatile period, and this is shown at the bottom, the benchmark gains 5% one day, but loses 5% on the next day. And this causes a compounded loss of 0.25% over 2 days. The fund, however, loses 1% over the same period, so that's worse than 2 times the negative 2.5% benchmark return, or negative 0.5%. So you can see how compounding negatively impacted returns during a volatile range-bound period. Next slide, please. Okay, so that 2-day compounding example that we just reviewed, that's helpful to illustrate the concept of compounding, but I often get asked for more real-world examples of the compounding impact. Let's take a look at some different periods recently. So in these graphs, we show the historical return of a hypothetical 2x NASDAQ 100 fund compared to the returns of the NASDAQ 100. And I do want to note that these hypothetical 2x NASDAQ 100 fund performance numbers do not include fees or expenses. But starting with the graph on the left, 2019, when we think back to 2019, that was generally a strong year for equity. And from June 4th through July 15th, that was a period of a little bit more than a month, and the NASDAQ 100 trended higher and increased 11.3% with relatively low volatility. The hypothetical 2x NASDAQ 100 fund returned 23.6%. Now, as we previously covered, a 2x NASDAQ 100 fund should not be expected to simply deliver 2 times the return of the NASDAQ 100's return, or 2 times 11.3%, which is 22.6%. Here, the hypothetical 2x fund actually returned 23.6%. Now, let's switch gears and look at the graph and table on the right. So following the COVID-driven market bottom in March 2020, we all know that equity indexes rebounded pretty strongly. However, from September 2nd to November 28th, there was a bit of a pause in the NASDAQ 100's upward trajectory, and returns were range-bound and trendless, and volatility was more elevated for that period. So you can see that the NASDAQ 100 returned a negative 1.1% return over this roughly 3-month period, but the hypothetical 2x NASDAQ 100 fund actually returned negative 4.4%. So here we can clearly see that the negative impact of compounding, what that looks like in a trendless, higher volatility environment for a leverage fund. So hopefully these two examples help bring to life the impact of compounding. We saw how compounding enhanced returns in the trending environment, but also hurt returns in the trendless and more volatile period. And this reflects standardized performance for the 2x ProShares Ultra QQQ fund as of March 31st, 2021. So for investors who want to hold their leverage or inverse ETFs for periods longer than a day, it's important to, one, closely monitor your positions and to consider rebalancing. That's a very important point when it's appropriate. So let me just introduce this at a high level. Rebalancing is essentially a discipline. It can buffer the negative effects of compounding, but it can also produce the positive effects. It involves investors increasing or decreasing their positions at predetermined intervals to maintain their desired level of exposure to a benchmark. One thing to be mindful of is that there might be transaction costs and also tax consequences associated with rebalancing. And additionally, rebalancing might require capital to be available for periods when additional share purchases are required to increase your exposure. And finally, I did mention this earlier, but even with rebalancing, investors should still closely monitor their positions even as frequently as daily.
Thanks, Lex. And I'm glad you mentioned some of those considerations for using leverage and inverse ETFs over time and the importance of rebalancing. Let's now go through some common rebalancing strategies like trigger-based rebalancing or calendar-based rebalancing. Some of those approaches, could you explain what we mean by those two strategies and how they're utilized?
Sure, let's go into this in a little bit more detail. And as you mentioned, there really are two common strategies that advisors often focus on, what we would refer to as a trigger-based and also a calendar-based approach. Now that we've covered some considerations for using leverage and inverse ETFs over time, I do want to focus on these rebalancing strategies in a little bit more detail. So trigger-based rebalancing is when you set a trigger for when you want to rebalance. So for example, maybe you want to rebalance when the difference between the fund's return and the benchmark's return becomes greater than 10%. Now there's some consideration. The advantage of this method is that it's likely going to be more attuned to market conditions, but it might require frequent rebalancing, especially with inverse funds or leveraged funds with volatile benchmarks or larger multiples. On the other hand, let's look at calendar-based rebalancing. This is when you set a predetermined interval for rebalancing. This could be weekly, it could be monthly, or quarterly, for example. The advantage of this strategy is that you know exactly when and how often to rebalance. However, the disadvantage is that because this does not consider market conditions, performance may stray significantly from the benchmark return times the fund multiple during periods in between rebalancing. So let me take a minute to walk through how you could rebalance, and let's go through this step by step. Rebalancing can actually be pretty straightforward when we just break it down to a few steps. So here's how you could do it. Starting off with step one, decide when to rebalance. Do you want to employ a trigger or calendar-based rebalancing strategy? Step two, calculate the gap between the benchmark's return and the fund's return. So in this example, and this is using a hypothetical -2 times fund, we show the benchmark rising 5% and the -2 times fund falling by 10%. And the time frame for this performance is not specified, but it could be days, weeks, or months. This is an illustrative example. So here, the gap is 15%. The 5% return of the benchmark minus the -10% return of the fund. Step three, calculate the rebalance trade. So the rebalance trade is calculated as the initial value of the investment times 1 plus the benchmark return minus the fund's current value. So in this example, the initial value was $100. When you multiply that by 1.05, so 1 plus the 5% benchmark return, you get $105. Then you subtract the current value of the fund, which is 90, and that's how you get the $15 rebalance trade. Step four, monitor and repeat the rebalancing if necessary. So that's really the process for how an investor could develop a disciplined approach to rebalancing.
Yeah, thanks, Lex. And obviously we've covered a lot of the key foundational points of leverage and inverse funds, along with the rebalancing strategies that you went pretty in depth there. As we discussed early on, there are a number of ways to use these types of funds, including hedging or risk management purposes. Inverse ETFs are often used as kind of hedges to protect portfolios when you might expect a benchmark to go down. Hedging in this market environment, both on the equity and fixed income side of the equation here, can be an important consideration for many investors. A hedge can be tactically applied and removed as needed without disrupting your existing holdings or portfolio. It can be a way to help buffer market choppiness, stick to a long-term investment plan, and avoid trying to kind of time the market, potentially selling in a downturn and missing that rebound, that bounce off the bottom. Let's take a look at how hedging might look like in different markets. Lex, can you kind of take us through some of those examples?
Sure thing. And we often see investors applying hedges to their equity portfolios. So let's start there. Let's say an investor had U.S. equity exposure, and we can measure this by the S&P 500 index. And let's say they had this exposure when major U.S. equity indexes fell into bear market territory during the heart of the COVID-driven volatility. In this down market example, we compare 100% straight S&P 500 exposure. We compare it to a hypothetical portfolio that's S&P 500, but with a 10% hedge in a negative 1 times inverse product, so negative 1 times S&P 500. This example also includes a 10% rebalance trigger for the hedge portfolio. What you can see here is that the hedge not only provided less of a downside by about 5%, it also helped lower volatility overall. Let's now see how a hedged portfolio might perform in a rising equity market. It's important to look at both sides of the coin here. This period covers the fourth quarter of 2019, where the S&P 500 trended higher with relatively low volatility. Understandably, the hedge portfolio provided a bit less return compared to the unhedged S&P 500, but the hedge portfolio still delivered a lower volatility profile. So that's an important point. And I do want to mention that in both of these hedging examples, the inverse S&P 500 position is hypothetical and does not account for fees or expenses. And this is standardized performance for SH. This is as of March 31st, 2021. This is the ProShares short S&P 500 ETF. So let me look at this from a slightly different angle. And let's look at hedging fixed income exposure. We just talked about equity, so let's look at fixed income now. I'll start with hedging in a rising rate environment. And here we're looking at intermediate treasury exposure, and we can measure that by the ICE US 7 to 10 year treasury index. And we're looking at a period from September 30th of 2020 through March 4th, 2021. So that's a period where the 10-year treasury yield increased 88 bips from 0.68% to 1.56%. So a pretty meaningful move in a relatively short period of time. Similar to the equity hedging examples, the hedge portfolio does include a 10% hedge and a 10% rebalance trigger. Here, what you can see is that the 7 to 10 year treasury index lost nearly 6%, and the hedge portfolio buffered about 100 bips of losses, but again, also importantly, had that lower volatility profile. So I'll wrap up just by looking at the other side of the coin here in a falling rate environment. And we can look at a period from April 22nd of 2019 through August 15th, 2019. And this is a period where the 10-year treasury yield fell 106 bips from 2.59% to 1.53%. Here, the 7 to 10 year treasury index returned 9%. And while the hedge portfolio returned a bit less than the unhedged exposure, it again delivered the lower volatility profile. So I hope this gives you a sense of how hedging can work in different asset classes and also different market environments.
Thanks, Lex, and thanks for walking us through those hedging case studies. You know, we've covered a lot of important ground and concepts today, and I want to thank everyone for listening on this call. Before we end this call, I want to provide you with some key information for you to take away. So, you know, first of all, we are here to partner with you and assist in any way possible. So please feel free to reach out to us in any of the ways on this slide. Please note we do have different websites and contact information for ProShares, our ETF business, and ProFunds, our mutual fund business. Thanks again for that. And additionally, as we look here, I just want to stress you can reach out to us at 866-PRO-5125. Again, that's 866-PRO-5125. And here we have some additional concepts around risk and things for you to read through. But again, I'd like to thank Lex for joining me. Thanks, Andrew and Interactive Brokers for the partnership. And if there's anything we can do, please let us know. And on behalf of ProShares, thanks for joining and have a great day.
Thank you to both Troy Goldstein and Lex Garnett from ProFunds. Thanks for a wonderful presentation. And I'm going to forward you guys some of the questions that came in throughout the session. And thanks to everybody for joining us. Please do look out for that email in a couple of hours to view the recording, which will be displayed on ibkrwebinars.com. Look forward to having the ProFunds folks back on the platform in June. Thanks, everybody. Bye for now.